Welcome to the world of cryptocurrency, where fortunes can change in an instant. Bitcoin recently soared to new heights, only to plunge sharply, rattling investors everywhere. This volatility is classic crypto, but understanding the forces behind these swings is crucial. Right now, Bitcoin is hovering around $92,000 after a dramatic fall below $90,000. A relief, but also a source of anxiety. Is this stability a new foundation or just a pause before more turbulence? To answer that, we need to look at the bigger picture: global economics, investor sentiment, and especially the US Federal Reserve. We'll break down why Bitcoin dropped, why it's steadied, and what's keeping investors on edge. Plus, we'll see how other major cryptocurrencies are reacting to this climate. Let's dive into Bitcoin's latest chapter and what it could mean for the future. To truly understand the calm we're seeing in the markets today, we need to rewind and revisit the chaos that unfolded not so long ago. The numbers tell a story of wild swings, emotional highs and lows, and the ever-present uncertainty that defines the world of cryptocurrency. Just a few weeks back, Bitcoin was on a tear, surging past the $120,000 mark for the first time in its history. The mood was electric, optimism was everywhere, and investors, both big and small, were swept up in a wave of confidence. Social media buzzed with predictions of even higher prices, and financial news outlets couldn't stop talking about the new all-time high. But as quickly as the rally began, it unraveled. Selling pressure mounted almost overnight, and Bitcoin's price plummeted, crashing below the psychologically important $90,000 threshold. At its lowest, it touched $88,610, a staggering drop that left many investors reeling and wondering if the bull run was over for good. This sudden and dramatic fall sent shockwaves through the market. Investors watched in disbelief as their portfolios shrank, and panic began to spread. The fear wasn't just about Bitcoin, it threatened to spill over into other assets, raising the specter of a broader market meltdown. Yet, in the midst of the turmoil, opportunity emerged. Savvy buyers saw the dip as a chance to get in at a discount, and their renewed interest helped Bitcoin stage a quick rebound. The price stabilized around $91,180, restoring a measure of confidence and halting the free fall, at least for now. This fragile stability is more than just a number on a screen. It's a lifeline for the market, preventing a total collapse and giving everyone, from day traders to long-term holders, a moment to catch their breath and reassess their strategies. But what caused this wild ride? The answer isn't simple. It wasn't a single event, but a complex mix of factors, ranging from shifting investor sentiment to global economic uncertainty, and even rumors swirling around regulatory changes. Chief among these was growing caution about the US economy. All eyes were on the Federal Reserve as investors tried to anticipate its next move. Would interest rates rise? Would new policies tighten liquidity? Every hint from the Fed sent ripples through both traditional and crypto markets. When traditional finance gets nervous, the effects are magnified in the world of crypto. The interconnectedness between Wall Street and digital assets means that uncertainty in one market quickly spreads to the other, amplifying volatility. The link between old and new finance has never been stronger. Institutional investors, hedge funds, and even banks are now deeply involved in crypto, making the fates of these markets more intertwined than ever before. And so, Bitcoin finds itself in a delicate balancing act, caught between optimism and fear, innovation and tradition, stability and chaos. The numbers may look calm for now, but beneath the surface, the story is far from over. To truly understand the mood and direction of the crypto market, we need to look beyond just the price charts and blockchain technology. There's a powerful force looming in the background, one that shapes the very environment in which crypto operates. That force is the US Federal Reserve, the central bank of the world's largest economy. Its influence stretches far beyond traditional finance, casting a long shadow over digital assets like Bitcoin and Ethereum. The Fed's main job is to set interest rates and guide the US economy. But every decision it makes, whether it's raising rates to fight inflation or lowering them to spur growth, sends shockwaves through global markets. Crypto is no exception. Even though cryptocurrencies were designed to be independent of governments and central banks, the reality is more complicated. The Fed's policies can indirectly impact everything from Bitcoin's price to the mood of crypto investors worldwide. In theory, Bitcoin should be immune to central banks. In reality, it's not. The dream of a financial system outside government control is challenged every time the Fed makes a move. Today, large institutional investors treat Bitcoin and other cryptocurrencies much like stocks or tech shares. When the Fed signals a change, these investors often adjust their crypto holdings just as they would with any other risky asset. When the Fed raises interest rates, borrowing money becomes more expensive. The economy tends to slow down, and investors look for safer places to park their cash. Risky assets, including crypto, often see their prices fall as a result. On the flip side, when the Fed lowers rates, it encourages risk-taking. Investors are more willing to put money into assets with higher potential returns, like Bitcoin, which can lead to price surges and renewed optimism in the crypto space. This is why crypto traders and investors obsess over every word from the Fed. Each statement, press conference, or policy hint can spark a wave of buying or selling across the entire crypto market. The Fed's signals can trigger major price swings in Bitcoin and beyond, sometimes within minutes. Volatility often spikes as traders react to the latest news. Right now, all eyes are glued to the Fed's next move. Will they raise rates again, or pause to see how the economy responds? The uncertainty keeps markets on edge. The crypto market is hanging on every word, every hint, and every forecast. For many, the Fed's decisions are just as important as any new blockchain upgrade or regulatory announcement. The connection between central banks and digital assets has never been clearer. In today's world, even the most decentralized currencies can't escape the gravitational pull of the Federal Reserve. Interest rates are at the heart of today's market anxiety. They influence everything from the cost of borrowing money to the returns on investments. When central banks, like the Federal Reserve, adjust these rates, the ripple effects are felt across the entire economy. When rates are low, borrowing is cheap, businesses expand, and investors chase higher returns in assets like Bitcoin. This environment encourages spending and investment, fueling economic growth. Companies take out loans to invest in new projects, hire more employees, and increase production. That's helped fuel crypto's rise in recent years. Low interest rates have made traditional savings less attractive, pushing investors towards riskier assets with higher potential returns, like cryptocurrencies. This influx of capital has driven up the prices of digital currencies significantly. But when the Fed talks about raising rates to fight inflation, everything changes. Higher interest rates increase the cost of borrowing, which can slow down economic activity. This is a tool used by central banks to cool off an overheating economy and keep inflation in check. Higher rates make borrowing costly and safe investments more appealing, draining money from riskier assets. Investors may shift their focus to bonds and savings accounts, which offer better returns in a high-interest environment. This shift can lead to a decrease in the prices of stocks and cryptocurrencies. This is called quantitative tightening, and it's a big reason for the current caution. By reducing the money supply and increasing interest rates, central banks aim to stabilize the economy. However, this can also lead to reduced liquidity in the markets, making it harder for businesses and consumers to access credit. The Fed faces a tough choice: raise rates to fight inflation or cut them to support a weakening economy. Balancing these two objectives is a delicate task. Raising rates too quickly can stifle growth, while keeping them too low for too long can lead to runaway inflation. This uncertainty is making investors nervous. They are closely watching the Fed's moves and statements for any hints about future policy changes. The lack of clarity can lead to increased market volatility as investors react to every piece of news. If the Fed keeps rates high, Bitcoin could fall further. High interest rates can reduce the appeal of riskier investments like cryptocurrencies, as investors seek safer, more stable returns elsewhere. This can lead to a sell-off in the crypto market. If it cuts rates, crypto could rally. Lower interest rates can make riskier assets more attractive again, as the potential for higher returns outweighs the risks. This can lead to increased investment in cryptocurrencies and a rise in their prices. The market is stuck waiting for a clear signal. Investors are in a holding pattern, trying to anticipate the Fed's next move. This waiting game can lead to periods of low trading volume and increased market tension. That's why interest rates matter so much right now. They are a key factor in determining the direction of the economy and the financial markets. Understanding their impact can help investors make more informed decisions in these uncertain times. The market's caution comes straight from the Fed's latest meeting. The Fed is split. Some want to cut rates if the economy weakens, which would boost Bitcoin. Others worry about inflation and want to keep rates steady. This indecision is weighing on investors who are waiting for a clear direction. Fed Chair Powell calls it navigating through a fog, a perfect description of today's uncertainty. With no consensus, expectations for a December rate cut have dropped, dragging Bitcoin down. Investors are caught between hope for a rally and fear of a deeper correction. Until the Fed clarifies its stance, sideways trading is likely. Bitcoin is stuck in a tug-of-war between optimism and caution. The fog thickens with a rare problem: missing jobs data. A government shutdown delayed the October employment report, so the Fed will make its next decision without fresh labor market info. This data gap makes it even harder for the Fed and investors to judge the economy's true health. The result? More uncertainty, and a crypto market stuck in limbo. Bitcoin's uncertainty is rippling through the entire crypto market. Ethereum, the second largest coin, dropped 1.8% to around 3,025s, showing even strong projects aren't immune. XRP also slipped, down 1.6% to 2.13, as macro fears outweigh individual news. When Bitcoin stalls, altcoins usually follow. The top 3 coins are moving in sync, highlighting how interconnected the market is. Right now, fear of the Fed's next move is keeping all major cryptocurrencies under pressure. Until the outlook clears, caution rules the market. Beyond the top coins, most altcoins are also struggling. Solana has managed a slight gain, possibly thanks to strong community support. But Cardano and Polygon have slipped, reflecting the broader bearish mood. Even meme coins like Dogecoin and Trump are down, signaling a sharp drop in risk appetite. When meme coins fall, you know caution is everywhere. The lesson: in times of macro uncertainty, nearly all crypto assets move together. Diversification within crypto doesn't always protect you from market-wide downturns. The entire space is feeling the Fed's shadow. As the year ends, the crypto market is holding its breath. The next big event, the Fed's December meeting. If the Fed hints at rate cuts, Bitcoin could rally and bring altcoins with it. If the Fed stays hawkish, another drop is likely. The only labor data before the meeting is old, so any surprises could spark volatility. For newcomers, this is a lesson in how deeply crypto is tied to global economics. Bitcoin's fate now hinges on central bank policy and traditional data. The key: watch the Fed, expect volatility, and be ready for anything.